Welcome. So today we're going to unpack one of the biggest, boldest economic experiments in modern history. And we're going to do it by telling the story of the one guy who, right from the start, said no. Let's dig in and find out why. Okay, so picture this. It's 2010. We're just 2 years out from the 2008 financial crisis, and the global economy is still, incredibly fragile. The people in charge at the Federal Reserve are about to make this absolutely monumental decision. But inside a room that's basically built on consensus, one lone vote is about to break ranks. Not just once, but over and over again. So who was this guy? And what on earth made him so determined to stand up to, well, the most powerful economic policymakers on the entire planet? I mean, just listen to this. This quote really captures the sheer weight of that one little word, no. Can you imagine? You're sitting around this massive, polished table with all the top economists in the world, and they're all looking at you as you say no. The man who said it, Thomas Hoenig, the president of the Kansas City Fed, he felt that pressure, big time. And here's the thing, it wasn't a one-off. Throughout the entire year of 2010, every single time the Federal Open Market Committee voted on this new policy, Hoenig's vote was the same. It was no, then no again, and no, 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 and for a sixth time, no. In an institution that is all about consensus, this was just completely unheard of. And this is what makes this whole story so fascinating. See, Hoenig wasn't some natural-born rebel. He was the ultimate insider, a total rule follower, a Vietnam vet, son of a plumber from a small town who worked his way up to a PhD in economics. He spent his entire career inside the Fed system. I mean, this is the last guy on earth you'd expect to become the lone dissenter. So the question is, what did he see that everybody else was missing? All right, to really understand his dissent, we have to get into the plan he was voting against, and it was a pretty radical plan. It was championed by a man who, at the time, was one of the most famous and influential people in the world, the Fed chairman himself, Ben Bernanke. So the plan had a name, quantitative easing, or QE for short. Now, in the simplest terms, the Fed was basically going to create trillions of dollars out of thin air. Just poof! And with that money, they'd buy bonds from the big banks. The whole goal was to force all this new cash into the economy to get people lending, spending, and investing again when nobody else would. And this comparison really shows you just how radical QE actually was. Think of the Fed's traditional job like they're engineers at a nuclear reactor, making these tiny, super careful adjustments. Well, QE, that was like ripping out the entire control panel. Instead of just gently tweaking short-term interest rates, they decided to just flood the whole system by going after long-term bonds. I mean, the very bedrock of the financial world. And how it worked was, honestly, deceptively simple. The Fed's traders in New York would literally just get on the phone with a big bank, say JP Morgan, and offer to buy billions of dollars in bonds. Then, and this is the crazy part, with just a few keystrokes, they'd create the money to pay for it. Boom, it just appeared in JP Morgan's digital account. And all this brand new cash, well, it had to go somewhere, which forced investors to start hunting for riskier and riskier places to get a return. Yeah, Hoenig did not mince words about this. He didn't see some brilliant solution here. He saw a really, really dangerous bargain. He was convinced that the short-term benefits of QE were blinding everyone at the Fed to the catastrophic long-term risks they were taking on. So what exactly was this deal with the devil he was so worried about? Okay, so most critics at the time were screaming about one thing, and one thing only, inflation. Right? The idea was if you print trillions of dollars, the price of everything from milk to bread is just going to skyrocket. But here's the twist. That wasn't Hoenig's main concern. Nope, he was worried about something way more subtle, and in his view, ultimately far more destructive. Hoenig's number one concern was something called the allocative effect. He argued that QE wasn't this neutral force that would, lift all boats. No way. He saw it as a policy that actively picked winners and losers. By crushing interest rates down to zero, it punished regular savers while basically handing a reward to Wall Street speculators and people who were already rich in assets. To him, this was a fundamental re-engineering of the entire economy. And that, of course, led to his second huge fear. I mean, think about it. If the Fed is pushing all this new money into the system and it's forcing everyone into riskier and riskier investments, well, where is all that money going to go? Honing was absolutely convinced it would just inflate massive new asset bubbles, just like the ones that caused the last three major financial crises. And for him, this wasn't just some abstract theory. He had a front row seat to this movie before. As a career Fed guy, he had seen the exact same pattern play out, time and time again. First, easy money policies create a massive boom. Then, assets get wildly overpriced. And then, the whole thing comes crashing down, and it devastates the real economy. He looked at QE and just thought, here we go again. He believed the Fed was making the exact same mistake. So what happened? What were the actual consequences of this policy? Did Honing's fears come true? Well, for the better part of the next decade, QE completely and fundamentally reshaped the entire financial world. And you can see the core of the problem right here. Before the 2008 crisis, if you bought a super safe government bond, you could expect a decent 5% return. But after QE, the Fed intentionally crushed that yield down to 2% or even less. All of a sudden, the safest investment on planet Earth couldn't give you a meaningful return anymore. And that kicked off what economists call the search for yield. Just try to imagine it. Trillions of dollars that used to be perfectly happy sitting in safe government bonds are now unleashed, and they're just desperately roaming the globe, hunting for any investment that will pay them something, anything, more than basically zero. So where did all that easy money end up? Well, it chased risk absolutely everywhere. It flooded into corporate debt, but instead of using that money to hire people or build new factories, a lot of companies just bought back their own stock to boost the share price. The money fueled these wild speculative booms in everything from the US fracking industry to commercial real estate. Pretty soon, traders started calling it the everything bubble, because it just felt like the price of every single asset was going nowhere but up. And that whole decade of easy money, it felt pretty good while it lasted. I mean, asset prices were high, Wall Street was happy, but as we all know, eventually the bill comes due. And Honig's warnings about creating a fragile, bubble-prone system, well, they were about to be proven right in a very big way. The first real crack appeared in a corner of the market that almost nobody has ever heard of, the repo market. The easiest way to think about it is like the overnight plumbing for the entire financial system. It's how banks lend to each other. Well, in September of 2019, that plumbing just froze solid, and the Fed had to jump in with a $400 billion emergency bailout. It was the first real sign that the foundations of the system were dangerously unstable. And then, of course, the pandemic hit in 2020, and the whole system just buckled. The Fed's response this time was astronomical, an immediate injection of over $2 trillion. That made the 2008 bailouts look tiny by comparison. And really, that was the moment. It revealed the true nature of the system that had been built over the past decade. And this is what really revealed the trap. By keeping the system on life support for a whole decade, the Fed had essentially created an addict. The financial markets had become so utterly dependent on that easy money that the Fed was trapped. It couldn't pull back support without triggering the exact kind of crash it was supposed to be preventing. And that brings us to Honig's final, pretty chilling warning. I mean, after spending an entire decade engineering a whole new economic reality around zero, how do you ever get back to normal? Can you? And what happens when you try? That's the multi-trillion-dollar question that, honestly, we are all living through right now. Good luck, indeed.